5 tips for your first investment. Are you stepping into the investment world for the first time and not knowing anything about it? Well, then you've come to the right spot. Like many others, you must also wonder and contemplate where to start. Well, it is all about starting as far as your investments are concerned, but the important thing is to know a few pointers before putting your hand in the bag. Some essential guidelines will be told by us today because we believe that everyone starting with investing their money deserves to be told these things, since nobody will come up and ask them to you. It isn't advised to follow these tips religiously, but if you do incorporate them into your financial input, they will bring you a lot of benefits. Here are 5 essential tips to know for your first investment. Diversify your portfolio. Starting, we have diversification. Investing money becomes hassle-free when your investments are diversified. Overall, to diversify, your strategy is to spread your investments across different markets, sectors, asset classes or types, and various international markets. You can put together several funds that give you a balanced exposure to international stocks to diversify. You can get exposure to different asset classes and sectors, such as gold or the technology sector, using ETFs. You can also diversify into real estate using REITs. Using a small percentage of 2 to 5% of your overall portfolio to invest long-term into cryptocurrency exposes you to that market. The goal is to look for inverse correlatable or non-correlatable investments, which means they either move in opposite directions or have no relationship whatsoever. An example of an inverse correlatable investments is stocks and bonds. The bond prices tend to move in the opposite direction of stock prices, which can help you balance the risk of those stocks. An example of a non-correlatable investment is stocks and the real estate market. If you feel like these different investments are too hard for you to manage to keep a balanced, diversified portfolio, you can pay someone to do it for you. This method is usually adopted by the best investors who pay people to handle their investment portfolios to ensure they are well diversified. If you're getting started, we recommend you use this method. As you invest, you'll see that markets have a habit of moving up and down, hence the need for different types of investment funds. This diversity will help you stabilize your portfolio over a long economic cycle. The reason it will help you in the long run is that it will help you decide which investment is worth going after and subsequently drop the ones that offer the least profits. Investing exclusively in particular markets, sectors, or companies can expose you to unforeseen issues in a specific area. Investing across a wide range of asset classes and sectors helps minimize potential losses and maximize long-term returns. Research. Before you invest your money in any investment, do carry out the proper research. Search every area that you think has potential. Take a look at all the available investment opportunities for you in the amount of money you're willing to invest. We shall look at real estate as an example. When investing in real estate, you can check areas where new restaurants are moving, new workplaces are being built, and new apartments or subdivisions are being made. Other services, such as schools, hospitals, and access to public transit also matter. All these things are indicators that the price of the area will shoot up soon. Also, look for a property with the fundamental features but looks run down from the surface. These are prime opportunities for quick renovations or remodeling, like painting or changing fixtures to modernize the property will create instant equity. If you find a property with all these factors, you may have found an opportunity for a real estate investment. It's best to check future development plans for neighborhoods, as this is where you can know what to expect and potentially get a deal on the investment before it rises in price once everything is fully developed. The trick is to see a fully developed area before it is developed. Please don't mistake seeing things for what they currently are, as the price increases come from future development through time. This is how the people of stories you hear on how they got in before the big boom. They saw a fully developed future and bought ahead of time, and it all starts with research. Make sure you're willing to put in the effort to carry out your research. Without research, you'll be way behind the pack because your competitors will have done their research and already have a good start ahead of you. There are several ways to carry out research. Nowadays, everything is present on the internet. Still, suppose you would like to receive more solid professional advice. In that case, you can always seek the advice of financial professionals and entrepreneurs who have been investing most of their lives. Listening to people with expertise in finances will give you a lot of new ideas. Before you spend your first chunk of money, it is essential to look at the pros and cons. This is because your succeeding or failing in your first investment will decide how you will take your investment venture forward. It is essential to know that even if your first investment doesn't succeed, you don't need to lose hope. It will help if you put in the effort to research all the good and the bad. A quick reminder, if you've enjoyed the video so far, consider subscribing, as we frequently upload such informative and educational videos. Let's continue. Investing regularly. Whatever speculations you hear regarding investments, block them all out. You need to consider the long-term future value of the company that you're investing in. Very small companies can be riskier to invest in purely because they are not regulated as larger companies. Larger companies have a better experience in being run, and they have more exposure, which is why they usually solve discrepancies in a shorter time. It is foolish to think that increased risk guarantees more money. Chances are there to be taken, but calculated risks. Wouldn't you bet on a pony in a horse race now? Furthermore, invest regularly. We cannot stress this point enough. Even if you're starting small, don't back out at the last moment just because your investment isn't as much as the more prominent players out there. Investing little and often is sometimes better than investing more significant sums of money. Researching investments has shown that even professionals recommend you to invest consistently. By starting to invest early and regularly, you can take advantage of compounding that will help to bring you better profits. All you need to put in place is a good investment technique. Many people make the mistake of giving importance to the amount of money they're investing in. It doesn't matter your amount as long as you're investing regularly in chunks. One more thing to keep in mind is to know that profits will be secondary. It would help if you focused on how much you're getting to learn with your investments. This is precisely why we've talked about investing in small quantities. When you support small, you get to know about your mistakes and where you could have done better. Now, ask yourself, are a few bucks at the moment better for you, or information that holds such massive value? Take the above normal calculated risks. When investing, the first thing to do is assess your risk tolerance. Usually, the way it goes is when a person is younger, they take the most risk as they can recover from any market downturns. Then, as they approach retirement, they reduce their risk tolerance significantly as they want to protect their investments from any losses as they will be starting to use that money. If you're investing at the age of 30, you are still very young in the investor life cycle as you have 30 more years until you retire. The factor of time is in your favor. It allows you to take on higher than ordinary investment risks, deploying most of your long-term savings in stocks, mutual funds, cryptocurrency, and real estate. As an investor, you need to know taking risks isn't bad as long as they are calculated risks. With 20 to 30 years left till your retirement age, consider being riskier than people older than you. Having a higher risk tolerance will provide higher rates of return, and with more time to recover from any short-term corrections, you will have much more money when you retire. Your investments aren't bound by time, and neither are you running out of it. Make sure to keep your risks minimal and to keep moving at your own pace. As long as you make the right decisions, things will immediately fall into place. But it is better to handle a loss that you can bear rather than paying off loans for most of your later life. Setting the right goals. Most of the rich people around you aren't born with all the privileges in the world, but what they are good at is setting their goals. The initial step to investing your money is to select the right goals, be it long-term or short-term goals. Goals help you to have a purpose. They prevent procrastination and assist you in meeting deadlines on time. Whether your first investment, savings goal, an emergency fund, or buying a property, setting the right goal is the first step toward making money for yourself. A great example of putting your financial goals could be that you're hoping to save a specific amount of money by the end of this year, so that when the next year starts, you can invest that money of yours. Until you don't have a plan to save that money of yours, you won't ever get to invest it. Hence, you can ultimately forget about making more money. This is just a small example of how you need to set goals for yourself to accomplish. And it's not just about setting goals, you need to fulfill those goals as well. That will be done by willingness and eagerness to meet timelines from your end. Having the right plans in place will help you achieve more than before. Believe it or not, staying determined and keeping the right goals in front of you will do wonders. These 5 tips could be from a gold mine if you know how to execute them. This invaluable information could play a massive part in your financial success, so make sure to follow this, and you too could make some handsome amounts with your first ever investment.